So, before the break I was talking about the relationship between riskiness and return, and what we found was that if there are two assets A and B and both have the same future value, then assuming that A is less risky and B is more risky, the present value, which in a sense represent the prices of the bonds or the intrinsic value of these instruments, are of A being less risky would be higher compared to the price of B, which has a higher risk and therefore a lower price. And this implies that the discount rate used for discounting A, which has a lower risk, would be lower, and the discount rate that is used for discounting the payoff of B, which has a higher risk, has a higher value. In other words, the discount rates carry a component of risk, are adjusted with respect to risk, and higher the risk, higher is the discount rate. As we shall see later, these discount rates actually represent the expected returns on the underlying securities in an equilibrium market, and this is illustrated here in this particular diagram. Again, we have three assets. We have the asset H, which is the highest risky asset, the asset L, which is the intermediate risk, and we have the asset F, which has the lower risk. All of these three assets are being traded as of today at 100. Now, what happens to the future values or the values at t equal to 1? We can obviously, because H is the highest risky asset, the investor who invests in H at t equal to 0 would demand a higher rate of return, and in order that he gets a higher rate of return, the expected price or the expected value of the asset at t equal to 1 for asset H must be the highest. This translates to the statement that higher the risk, higher should be the expected return on the asset, in order that the asset is able to sustain itself in an equilibrium market. I repeat, higher the riskiness of an asset, higher has to be the expected return on that asset, in order that the asset sustains itself in an equilibrium market. Otherwise, what will happen is, if an asset has a higher risk and a lower expected return compared to another asset, arbitrage will start. We will talk about arbitrage very soon. So, let me briefly summarize what I have been discussing so far. This means that for equally priced assets now, that is, as if there are two assets A and B which are equally priced, in a year from now we can expect a risky asset to be worth more than the riskless asset or the lower risk asset. And again I repeat, this implies that the expected return on the risky asset needs to be higher than the lower risk asset in an equilibrium market. In other words, increased riskiness means greater returns, but only on the average. This is fundamental. I have to underline this to bring to you the significance of this particular portion. So, increased riskiness means greater returns, higher the risk, higher the returns, but which return? Expected returns. It is not the actual returns. If you are talking about actual returns, there is no question of risk really, because once the actual return is realized, and that is a post facto event. So, that there is no riskiness attached to that, there is no uncertainty attached to that, and there is no riskiness, and that value that we have already obtained is a certain value. So, there is no question of riskiness there. However, we are talking about future values here, the today's price with the future values. Now, in the case of future values, what we say is that higher the riskiness given a given investment value, higher has to be the future expected value. But that the important point, the cardinal point is the word expected value, expected return, expected price, expected value. It is not actual price, it is not actual value. What that means is that while the expected price or the expected return has to be higher in order that the asset sustains itself in an equilibrium market, it is also necessary. It is also necessary that, or it is also a fallout that because it is highly risky, the asset is higher in terms of risky, it follows that the expected return that we are going to get could be defaulted upon in a greater number of cases, or a greater with a greater probability compared to an asset which has a low risk. For example, if an asset is riskless, there is no question of default, and even though if it has a lower value, then that value is absolutely certain and there is no risk. So, that return is certain, but if there is an asset with a high risk, it may give you a higher expected return, but there would also be a higher probability of that asset defaulting in providing you that higher expected return. Now, we talk about arbitrage. I made a very brief passing mention about arbitrage. Let us look at what arbitrage actually means. Look at this diagram. As I mentioned, whenever we talk about investment appraisal, investment evaluation, we talk about a two-dimensional framework. It is conventional that the risk is taken along the x-axis and the expected return is taken along the y-axis. For the moment, we need not delve into what measure of risk we are adopting. Any measure of risk would be adequate. The exposition that I am now talking about is pretty much applicable across all measures of risk, so long as they identify a high risky asset from a lower risky asset. Now, let us consider the assets A and B. Let us consider the assets A and B in this diagram. Now, as you can see here, A has a higher expected return than B for the same level of risk. I repeat, for the same level of risk. Now, if the market is to be in equilibrium, these two returns, what will happen? Because A is giving you a high return for the same level of risk as B, the demand for A will increase and the demand for B will decline. People would try to get into investment A and people would try to get out of investment B, because B is providing you a lower level of return corresponding to the same level of risk as a security A. There is a security in the market which is security A, which is providing you higher expected returns compared to security B, which is providing you lower expected returns, but with the same level of risk. So, obviously, any rational investor would enter investment A and exit investment B. Now, what would happen is, as a consequence is that the demand for the asset A would increase, would escalate, whereas the demand for the asset B would decline, would fall. And with the fall in the demand for B and the increase in the demand for A, what happens to the prices? The current prices of A will go up, will shoot up, and the current price of B will go down, will decline, will be suppressed. As a consequence, the returns on security A would fall, the expected returns on security A would fall, the expected returns on security B would increase, and they would tend to converge. In other words, the points A and B as in an equilibrium market would tend to converge. Similarly, if you consider security C and D, you arrive at a similar conclusion. C and D both provide you the same level of expected returns, but C has a significantly lower risk compared to D, and again, because risk is viewed as an unfavorable attribute by investing community, it follows that people would exit investment D, people would enter investment C, prices of C would increase, prices of D would decline. Now, whatever I explained by this diagram can be summarized into a very important theorem, which is connoted as a law of one price. It is so important that it is termed as a law, and it is called the law of one price. In the absence of interfering and distorting factors like liquidity, financing, taxes, credit risk, etc., identical sets of cash flows should sell for the same price. I repeat, identical sets of cash flows should sell for the same price. So, if you have two assets whose cash flows are identical at any future date, then they must be selling, or they must sell at the same price. If they don't, the phenomenon of arbitrage will come into play, and gradually the arbitrage profits would be extracted out of the system, and consequently what would happen is that the two assets would converge in terms of their returns. What is identical is a very fundamental question. It is not trivial, it is by no means trivial. Identical implies perfect substitutes. So, when we are talking about identical cash flows, the cash flows should be such that one stream of cash flows can be substituted by the other stream with perfection, with no distortion in the system whatsoever. So, identical implies identical in all respects. This is to reiterate what I have just highlighted, what I have just emphasized. Identical implies identical in all respects, including identical outcome in every possible state of nature, and hence an identical probability distribution of outcomes. So, if two cash flows are to be identical, if they are random variables if they are certain, it is a different matter. If they are random variables, that means the cash flows corresponding to different states are different. Then the cash flows that arise from asset A and the cash flows that arise from asset B, in each state of nature, whatever the state of nature may arise, must be identical, and it implies that they must have an identical probability distribution. Secondly, identical also implies, identical also necessitates. You see, so far I have not mentioned anything about interaction between securities, but it so happens that there is hardly any pair of securities which in our universe of securities which have absolutely no interaction with each other. Two securities, particularly when we talk about equity shares, definitely or usually do have interactions. So, interactions between these two securities that are involved in the arbitrage process must be identical. The level, quantum and quality of interactions between the two securities, or between the securities A and the universe and security B and the universe must be absolutely identical. So, identical also implies that identical interactions with the entire universe of securities. That is, both these points that I have highlighted just now are captured by saying that the two cash flows must necessarily be perfect substitutes of each other. They must be, I repeat, perfect substitutes of each other, and that means what? That means in an uncertain future value situation, the probability distribution of outcomes must be absolutely identical. And the second important point is that which we have ignored so far is that of interactions. The interactions of the two securities with the entire universe of securities must be identical with respect to each pair of securities that we have that we consider. Now, let us look at some arbitrage examples. Let us look at this example. We have two assets x and y. X and y are two assets, and both are being priced at 100 in the current market. In the current market, the price of x is also 100 and the price of y is also 100. The future values of these assets, of these investments, let us call them investment x and investment y. The future value of investment x, if the state alpha, now the future is characterized by only two possible states to keep the exposition simple, the state alpha and the state beta. If the state alpha materializes, the investment x has a payoff of 0, and if the state beta materializes on the date of exit of the investment, the outcome is a payoff of 110. And the investment y, payoff of 0 if the state alpha materializes, and if the state beta materializes, it has a payoff of 120. Now, as you can see here, because there are only two states alpha and beta, and we find that in the state of alpha, both the payoffs are identical, investment x and investment y. However, in the state beta, the investment x is giving you a payoff of 110. The investment y dominates, and is giving you a payoff of 120, and because both these assets are being priced at 100, this surely indicates the possibility of arbitrage, because two identically priced assets are not identical in respect of their future payoffs future or the probability distribution of the future payoffs. One is having a higher payoff in one state, and both of them are having identical payoffs in the other state in a two-state system, and as a result of which there is definitely a possibility of arbitrage in this example. Let us look at example 2. Example 2 has two assets P and Q, both of them again are priced at 100. Again we are talking about a two-state system, a two-state future where as on the date of exiting of the investment there are only two possible states, alpha and beta. If state alpha materializes, investment P gives you a payoff of 0, and if state beta materializes, it gives you a payoff of 20. And as far as investment Q is concerned, it gives you a payoff of 10 if state alpha materializes, and if state beta materializes, it gives you a payoff of 0. Now, what can we say about arbitrage? Prima facie, it would indicate to the layman that one would immediately react rather that asset P has a higher payoff in state beta and of 20, whereas asset Q has a payoff of only 10 in state alpha. Therefore, asset P is definitely superior to asset Q, and as a result of which, because they are trading at the same price, there should be arbitrage opportunities. But on a deeper level, on a deeper understanding of the problem, we find that it is not so trivial. The relative probabilities of state alpha and beta is not given in the problem, and because this is not given in the problem, we cannot say that the payoff of asset P is superior to the payoff of asset Q. What happens, for example, if the state alpha has a probability of, let us say, 75% and the state beta has a probability of only 25%. The absence of a probability distributions and probabilities of the occurrence or the possible occurrence of state alpha and beta not being given to you, the information is incomplete, the information is inadequate, and we cannot infer that the state Q is superior to state P or vice versa for that matter as well. Let us explore issue of arbitrage a little bit further. Now, let us talk about asset A and asset B. Let us say the price of asset A, the price at which asset A is trading at t equal to 0, that is the point of entry of the investment is PA, and let us assume that the price of entry into investment B is PB. And let us assume again a two-state future value, and in state alpha asset A gives you 0, in state beta asset A gives you 100, asset B gives you 90 in state alpha, and asset B gives you 90 in state beta. Let me repeat, in the asset A or the investment A gives you 0 in state alpha, gives you 100 in state beta, asset B gives you 90 in state alpha and gives you 90 in state beta. Can we say anything about arbitrage based on this information? No, we cannot. Obviously, we cannot. We are neither given the values of PA and PB, nor are we given the relative probabilities of state alpha and state beta. So, we cannot work out the expected values of the payoffs of investment A and investment B, but we can arrive at certain bounds here. Let us look at the situation more carefully, examine it more carefully. Suppose we construct a portfolio C. This methodology is very important when we talk about setting of bounds on options and other similar contingent contracts. So, let me explain this in a very simple manner. Let us form a portfolio C. We leave asset A as it is, we do not disturb asset A. We form a portfolio C which consists of asset B, and we add to it a bond which has a face value of 10 and which is trading at present value of 10 at the appropriate risk Okay. Let me repeat, I form a portfolio C consisting of asset B as it is, and I add to asset B a bond which pays of 10 in state alpha as well as in state beta. So, it is a default free bond. It is a certain payment irrespective of what is the evolution of the state of nature. So, bond B pays of 10 at if state alpha occurs, and it pays of 10 if state beta occurs. Okay. So, and we, because we are adding this bond to a portfolio, we have to pay a price for that, and the price of the bond is present value of 10 at the appropriate discount rate. Now let us look at the situation. In state beta, asset A is giving me 100, asset C or portfolio C is giving me 100. So, let me repeat, in state beta both the portfolio assets, asset A and asset C or portfolio C for that matter, asset A and portfolio C, the payoff of both these portfolios is absolutely identical if state beta arises. If state alpha arises, what we find is that as portfolio C is definitely superior to asset A. Asset A is having a payoff of 0 and asset C or portfolio C is having a payoff of 100. This total is this 90 plus 10 is 100, and here 90 plus 10 is 100. So, yeah, I can write this total here as 100, and I can write this total here as 100. Now, so what does it imply? Because as portfolio C is definitely superior in either state of nature, in state alpha it is obviously superior, in state beta it is identical. So, overall, whatever be the relative probabilities of alpha and beta, except of course, alpha having 0 probability, which we ignore, we find that the portfolio C is superior to portfolio A, and therefore, the price of portfolio C must be greater than the price of portfolio A, and therefore, we arrive at this relationship, price of portfolio C, that is P B plus present value of 10 is greater than P A. So, by use of arbitrage considerations, we have been able to set a upper bound for P A in terms of P B and a lower bound in terms of for P B in terms of P A. Now, this is a similar problem. I leave it as an exercise for the students, for the learners, a slightly more involved problem, but the principle is absolutely identical to what we discussed just now. So, I leave it as an exercise, and I hope these learners would enjoy working out this problem. Now, arbitrage, some fundamental issues. A set of transactions can be classified as arbitrage if and only if either the risk remains unchanged or the return remains unchanged. If both the risk and return change, the issue of risk return trade off crops up. And finally, there is no limit to the number of transactions that can be entered into for arbitrage. For example, you can do arbitrage by converting rupees to dollars, dollars to Great Britain pounds to Swiss francs, and from Swiss francs back to Indian rupees. You can indulge in any number of steps. After all, it is your own money, and you can indulge in any number of steps that you like if you feel that you are likely to realize an arbitrage profit. The caveat here is that with the increase in the number of transactions, arbitrage profit may be eaten away by market frictions like the bid ask spread and the lending borrowing spread and so on. So, the basic thing is arbitrage is generally achieved when there is a two-step arbitrage opportunity, or at best a 3-step arbitrage opportunities. If you have a larger number of steps involved in arbitrage, the frictions that are involved in the market in terms of buying and selling spread, bid ask spread, that is, may eat into the possible arbitrage profits. Now, we come to a formal discussion on arbitrage. We have talked about arbitrage, the definition of arbitrage. We have discussed arbitrage at the conceptual level. Let us now talk about the formal definition of arbitrage. What is an arbitrage portfolio? A portfolio is said to be an arbitrage portfolio if today it is of non-positive value, that is, it is of either 0 value or negative value. In the future, it has 0 probability of being a negative value and a non-zero probability of being a positive value. So, let me read it out again. This is very fundamental. It will be encountered again and again. The portfolio is said to be an arbitrage portfolio if today it is of non-positive value and in the future it has 0 probability of being a negative value. That means, it is either the probability of or the portfolio is certain to return 0 or a positive value. In other words, in the future the portfolio is certain to return a 0 or a positive value and today it has a non-positive value. Then it is called an arbitrage portfolio. Putting it in other words, putting it more simply in more conversant language, if a portfolio has 0 probability of returning a negative cash flow, that is, it is certain to return either a 0 value at maturity or a positive value of at maturity or at any future date, then it must entail a cost, a cash outflow. Please remember, cost is a cash outflow. So, it must entail a cash outflow to construct that portfolio at t equal to 0. So, let me repeat, if you are constructing a portfolio, if you are able to construct a portfolio that has either the possibility of returning a 0 value or a positive value, but no probability of returning a negative value, then it must entail cost or a cash outflow to construct at t equal to 0. If it does not do so, if it does not entail a cost to construct this kind of portfolio which has some probability of returning a 0 value and some probability of returning a positive value, a non-zero probability of returning a positive value. Please note this, the probability of returning a 0 value may be 0, the probability of returning a non-zero positive value must be non-zero. Then if you are going to construct that portfolio at t equal to 0, you must incur a cost, you must incur a cash outflow, and if you do not do so, if it so happens that a portfolio is such that it does not entail cash outflow to construct the portfolio, then it is an arbitrage portfolio. Theorem: if P and Q are riskless 0 coupon bonds with the same face value and maturity time t, this is important, let me underline this. P and Q are riskless. This riskless word is very important. It will come back when we talk about the proof to this theorem. If P and Q are riskless 0 coupon bonds with the same face value and maturity time t, then they are of equal value at all previous times. Without loss of generality, let P be dearer. You can either assume P to be dearer or Q to be dearer, it does not matter, you end up with the same result. So, let P be dearer at arbitrary time t less than capital T. Capital T is the maturity of the bond. At maturity of the bond is likely to return a certain value and that certain value is with certainty. Please note this point, these are risk free bonds. We construct an arbitrage portfolio consisting of P short, P is more costly, Q is cheaper. So, what we do? We sell P which is more costly and we buy Q and form a portfolio consisting of Q long, P short. Remember, P is more costly, Q is less costly, P is dearer, Q is cheaper. So, you buy the cheaper one and you sell the dearer one. Now, please note, the maturity cash flows of the two bonds are identical, and not only are they identical, they are certain. So, obviously, the maturity value of this portfolio comprising of Q long and P short will be 0. What about its value at t equal to 0? At t equal to 0, because you have sold P, you will get a high, and P is dearer. And P is dearer, therefore, you will get a higher value for P compared to the amount that you have to invest to get Q, because Q is cheaper. So, you get a positive cash flow at t equal to 0 corresponding to a 0 cash flow at t equal to the capital T, which is the maturity of the bonds. Clearly, this is an arbitrage portfolio, and therefore, arbitrage operations can take place. Due to this possibility of arbitrage, the prices will tend to converge, and the outcome is of what I have stated, that the outcome is that the two prices will tend to converge. I emphasize this theorem will hold only if the two bonds are riskless, because it is only then that we can cancel the cash flows at maturity of these two, or at least the bonds should be of identical risk. And because if you are having bonds of differential risk, then obviously this theorem breaks down. Okay, so we conclude today, and we shall continue from here in the next class. We talk about arbitrage free valuation of securities. How does the principle of arbitrage, how does arbitrage enable us to ascribe values to securities? That is the next issue that we will talk about in the next lecture. Thank you.